Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. Investing in sustainable agriculture funds isn't just about doing good, it's about smart money. These funds support farms and food systems that prioritize environmental health while still delivering returns. As climate concerns grow, so does the demand for responsible investments. Sustainable agriculture funds offer a way to balance profit with impact, making them a compelling option for forward-thinking investors. Here's why they deserve a spot in your portfolio. What are sustainable agriculture funds? Sustainable agriculture funds invest in farming and food production that prioritizes environmental health, social responsibility, and long-term financial returns. Unlike traditional agricultural investments, which often focus solely on yield and profits, these funds support practices like regenerative farming, water conservation, and biodiversity protection. They attract investors who want their money to grow crops and positive change. Key objectives of sustainable agriculture funds. These funds serve two main purposes: earning competitive returns and driving measurable impact. They achieve this by supporting smallholder farmers, providing capital to low-income farmers for sustainable practices, fair wages, or organic certification, reducing carbon footprints, investing in farms that use climate-smart techniques like no-till farming or methane-reducing livestock feed, promoting resource efficiency, backing projects focused on water-saving irrigation or renewable energy use in agriculture. For example, one fund might partner with coffee cooperatives to shift to shade-grown, pesticide-free methods. Another could finance soil health programs that sequester carbon. The bottom line: profit and purpose aren't mutually exclusive here. Types of sustainable agriculture funds. Not all funds operate the same way. Some cater to institutional investors, while others are accessible to individuals. Common structures include private equity funds. Typically target large-scale projects like sustainable agroforestry or organic supply chains, with longer investment horizons. ETFs and mutual funds offer diversified exposure to publicly traded companies in sustainable agriculture, e.g., organic food producers, precision farming tech. Impact investing funds focus on delivering measurable social or environmental outcomes alongside returns, often through smaller, community-based projects. If you're hands-off, an ETF might suit you. If you want deeper impact, private equity or direct impact funds could be the fit. The key is matching your goals with the right fund structure. Why invest in sustainable agriculture funds? Sustainable agriculture funds aren't just a feel-good investment. They're a strategic move backed by market trends, financial performance, and measurable impact. With climate risks reshaping global food systems and consumers demanding ethical products, these funds offer a way to grow your money while supporting solutions the world actually needs. Financial benefits. Investing in sustainable agriculture funds can generate strong returns while reducing risk. Here's how. Strong growth potential. The global market for sustainable agriculture is expanding fast. By 2030, regenerative farming alone could be worth over $1 trillion thanks to higher demand for responsibly grown food. Diversification. These funds spread risk across farmland, agribusinesses, and tech-driven solutions, balancing exposure when traditional markets fluctuate. Long-term stability. Farms using regenerative practices often see higher soil productivity over time, leading to steady yields and resilient income streams. Unlike conventional agriculture, which faces rising costs from climate-related disruptions, sustainable operations adapt better. Think of it as betting on farmers who work with nature, not against it. Environmental and social impact. Beyond profits, these funds drive real-world change. Money flows towards soil health. Practices like cover cropping and reduced tilling improve soil fertility, locking away carbon and boosting farm resilience. Water conservation. Efficient irrigation and drought-resistant crops cut water waste, protecting scarce resources. Rural communities. Investments help small farmers access fair wages, training, and markets, lifting local economies. Every dollar invested pushes the needle forward. Less pollution, healthier food systems, and stronger communities. That's not just good ethics. It's smart economics, as these practices future-proof the farms feeding the world. Now, consider this. What happens when your portfolio grows and helps fix broken food systems? That's the power of sustainable agriculture funds. How to evaluate sustainable agriculture funds. Putting money into sustainable agriculture funds isn't just about trusting the label. Like any investment, you need to dig deeper before committing. Here's how to separate high-impact opportunities from greenwashed ones. Key metrics to consider. Numbers tell the real story. Look beyond glossy impact reports and focus on these measurable factors, ESG scores. Most funds have third-party ratings indicating how well they perform on environmental, social, and governance criteria. A high score suggests stricter sustainability practices, but check which agency did the assessment. Some are more rigorous than others. Track record. How has the fund performed over 5 or more years? Consistent returns paired with verifiable impact like reduced farm emissions or improved soil health data signal credibility. Short-term spikes without context can be misleading. Transparency. Where exactly does your money go? Funds should clearly disclose holdings, farming methods supported, and even geographies served. Vague terms like sustainable initiatives without specifics are a red flag. A fund might promise regeneration, but if most of its portfolio backs industrial monocrops with slim sustainability upgrades, the impact isn't what you think. That's it for part 1. We've discussed the basics of sustainable agriculture funds and why they're an attractive option for investors. Stay tuned for part 2, where we'll dive deeper into how these funds can offer both financial returns and positive environmental impact. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.